Welcome to this explainer. If you are a BS accountancy student here in the Philippines, staring down the barrel of the board exams, you already know that cramming just doesn't work for taxation. So think of today as your ultimate cognitive survival guide for conquering the donor's tax for the LECPA. We are going to lock this stuff in. Because let's be real, how long can your brain actually retain these complex tax rules? The goal isn't just to pass tomorrow's quiz, right? It's to guarantee a solid 3-year retention rate, so this knowledge is right there with you when you actually sit for the LECPA in your second or third year. To make sure this information really sticks, we're going to use active recall, chunking, and strict mental boundaries to organize exactly how your brain processes the tax code.
So here is your mental roadmap for today. First, mastering donor's tax basics. Second, deductions and statutory exemptions. Third, cracking the cumulative computation. Fourth, foreign tax credit limits. And fifth, BIR compliance and deadlines. Knowing exactly what's coming reduces your cognitive load so you can just focus.
Okay, chunk number 1, mastering donor's tax basics.
Now you have to remember that donor's tax isn't a tax on the property itself. It's actually a tax on the privilege of transferring that property. The absolutely crucial point here is that it's a property tax on transfers during a lifetime, what the law calls inter vivos. This is totally distinct from estate taxes, which only trigger upon death. Oh, and watch out for transfers for less than adequate consideration. Say you sell a property worth 1 million pesos to your friend for just 500,000 pesos. Well, that 500,000 peso difference, it's deemed a gift and boom, subject to donor's tax. Unless, of course, it's real property classified as a capital asset, subject to capital gains tax.
Now lock this exact number into your mind, 250,000 pesos. This is your automatic exemption figure. But here is your very first study hack for the boards. This 250,000 peso exemption applies cumulatively per calendar year. It is not on a per donation basis. So if you donate 200,000 in January and another 100,000 in February, you don't get a fresh 250,000 exemption in February. The whole thing just resets every January 1st.
Moving on to chunk number 2, deductions and statutory exemptions.
Your brain needs a really clear filing system to separate these two concepts so you don't lose easy points. Think of deductions as literal mathematical subtractions from a specific property's value. Like if you donate a property that has a mortgage on it and the donee actually assumes that mortgage amount is deducted from the gross gift. Another deduction would be a diminution provided by the donor. Say you retain the right to use 10% of the donated land. Statutory exemptions, on the other hand, are specific transfers that are completely shielded from the tax right from the get-go. A classic example would be gifts made to the national government for public use.
Now, a really critical point is understanding the exemptions for NGOs. Yes, gifts to accredited nonprofit institutions are totally exempt, but, and this is a massive LCPA trap, watch out for the 30% rule. If an accredited NGO uses 35% of your donation to pay their office rent or executive salaries, actually, any administrative purpose that goes over that 30% line, your entire donation just lost its tax-exempt status. They have to prove that not more than 30% of the gift went to administrative expenses.
Let's look at a few special exclusions you absolutely must memorize because they are highly testable. Campaign contributions. These are exempt, but only if they're duly reported to the COMELEC and actually utilized during the official campaign period. If there are unutilized campaign funds or you donate for premature campaigning before the official window, no way, those drag you right back into taxable territory. Also, keep in mind that campaign expenditures are subject to a 5% credible withholding tax. Another super-modern exemption to take note of is for technical vocational institutions implementing enterprise-based education and training, or EBIT programs.
Okay, before we jump into computations, I need you to mentally hit the delete button on something right now. Remember that old 10,000 peso dowry exemption? It is completely dead, gone. Under the train law, gifts on account of marriage are no longer exempt. Please do not let older review materials confuse you on this. Today, all wedding gifts go straight into your gross gifts. Sorry guys, love just doesn't conquer taxes.
All right, chunk number 3, cracking the cumulative computation.
Let's see how you should logically sequence this annualized calculation within a single calendar year. By following these exact 5 steps sequentially, you guarantee you never double deduct that 250,000 peso exemption, and you always get credit for what you already paid earlier in the year. Step 1, take your current gift and add any prior gross gifts made within the same calendar year. Step 2, subtract valid deductions, like those assumed mortgages we talked about. Step 3, Subtract your static $250,000 annual exemption. Step 4. Multiply the net gift by the flat 6% donor's tax rate. And Step 5. Just subtract any donor's taxes you already paid earlier that year.
To really lock this in, let's put the cumulative mechanic into action using a donor named Mr. Kalau. In February, he gives $400K. We subtract that $250K exemption, leaving a net gift of $150K. 6% of that gives us 9,000 pesos payable. But now, check out May 14th. He gives another $500K. We don't just tax the $500K on its own. We have to add the prior $400K, which gives us a total gross gift of $900K. Then, we subtract that same static $250K exemption, leaving a net gift of $650K. 6% of $650K is 39,000 pesos. And finally, we deduct the 9,000 pesos he already paid back in February. So his tax payable for May is exactly 30,000 pesos. That is the cumulative rule in action.
Next up, chunk number 4, foreign tax credit limits. This part specifically applies to resident donors, so citizens or resident aliens, who give properties located abroad and pay foreign donors' taxes. To claim a foreign tax credit, you have to compute 2 limits. Limit A is calculated on a country-by-country basis. Limit B is a global limit that calculates all foreign countries combined against the total net gifts. If the donations span multiple foreign countries, you have to calculate both Limit A and Limit B. But the golden rule here for the board exams: you will always claim the lower amount between the actual foreign taxes paid and your computed limits. It's basically the government's way of ensuring they don't give you back more tax credit than the Philippine tax generated by that specific foreign property. And finally, chunk number 5, BIR compliance and deadlines.
Let's lock in some rapid-fire administrative rules that love to show up in the multiple-choice section. 30 days. That is your magic window. You have exactly 30 days to file your BIR Form 1800 from the date the donation is made, which is considered the date of delivery.
So what happens if you're feeling incredibly generous throughout the year? Well, if you make donations on different dates within the year, you have to file separate returns. However, if you make several donations to different donees on the exact same date, you only file one single return for that specific day. Also, definitely take note of this modern update. Thanks to the Ease of Paying Taxes Act, or EOPTA, you don't have to stress about specific venue rules regarding your revenue district office anymore. You can literally just file anywhere through any authorized agent bank or approved tax software. It's a real game changer.
You also need to pay close attention to the Notice of Donation rule. This is specifically geared toward business donors. If a business donates a gift valued at 50,000 pesos or more to a qualified accredited donee institution, they are required to secure a certificate of donation, that's BIR Form 2322, from the donee. Once they have that certificate, the donor has 30 days to file a notice of donation to the BIR. Why go through all this trouble? Because this is exactly how businesses ensure their donations remain fully deductible from their corporate income taxes, and it proves that the 30% administrative limit rule wasn't violated.
All right, let's wrap up this explainer with a final, pretty provocative LECPA trap just to test your active recall. Ready? If a donor donates a 5 million peso land with a 1 million peso mortgage on it, but the donor pays off that mortgage themselves, is that 1 million deductible from the gross gift? Think back to the exact definitions we covered earlier. The answer is a resounding no. For an encumbrance to be a valid deduction, it literally must be explicitly assumed by the donee. If the donor just keeps paying it, they are the one bearing the burden, which leaves the donee with a full 5 million peso gross gift. Keep your definitions strict, trust the chunks we built today, and you are absolutely going to crush this topic on the boards.